Hey guys, this is Alex Owari from Owned U.S Tax and Accounting Services. So in this video, we're going to be talking about certain transactions of foreign-owned U.S. single-member LLCs that triggers Proforma 1120 and the 5472 reporting of filings. For those that don't know much about the U.S. tax code, this Proforma 1120 and 5472 reporting requirement was included in this Code of Federal Regulation, Section 16038A-2. The need to file these forms was included in this section. So I will share this section with you. We'll Google it and see what's in there. And then within this section, the IRS did a really good job providing examples of certain transactions that triggers the Proforma 1120 and the 5472 reporting. So there are two unique examples that the IRS gives within this regulation. We're going to take a look at the first one. I will try and trim down the fact a little bit so that someone who doesn't know much about taxes will understand how the facts and the analysis work. So we'll look at the code itself and then we'll come back to this slide and then look at how all the fact works using the example provided directly by the IRS. So this example is not an example that I created myself. It's right in the code that mandated that foreign-owned U.S. single-member LLCs file this Proforma 1120 5472. So we'll go into the examples real quick. Alright, so if you want to know the Code of Federal Regulation that really brought about this filing requirement, you can easily Google the section. Okay, so the major sections you'll be looking at is Section Treasury Regulation 1.6038A-2 or 6038A-3. Now, if you look at the search we just did, you can see that within this Code of Federal Regulation, the IRS has provided two requirements for foreign-owned single-member LLCs. We always talk about filing the Proforma 1120 and the 5472. But one of the things we don't talk about it is the fact that you need to have a proper record maintenance. Now, what do we mean? Anything that you report on the 5472 form, you need to have a backup or reporting maintenance system to prove everything that you've reported on this form. So usually it has to do with documentation for payment between related parties. It has to do with keeping proper set of books so that if the IRS have certain questions, they can easily come to you and then you can produce your records to justify what you actually used to complete the 5472. This is the Treasury Regulation that you could find a requirement for filing that tax return, the 5472. Now, when you scroll down, the IRS provides two examples. So the first one is going to be this one, which we'll be talking about. So as you can see, it is very lengthy. The facts and the analysis are all here. So I'm going to break this down into layman terms and help you understand what's going on here. So we'll go straight into this and then talk through it. And in the next video, we're going to also look at the example 2, and then that should be the end of trying to discuss anything about foreign-owned U.S. single-member LLCs as it relates to the requirement of this return. So let's take a look at example 1 real quick. Alright, so we're going to take a look at this slide, okay? It's the same examples that we found in the Treasury Regulation, and I've tried to simplify it a little bit. So we'll look at the facts of this case. So in this fact, the IRS provided this example and said in year 1, W forms and contributes asset to X. So W here is a foreign corporation. So W, a foreign corporation, forms and contributes asset to X. So this foreign corporation could be anywhere in the world. It could be a foreign corporation in Africa. It could be a foreign corporation in Europe, Asia, Central America, South America. It could also be a foreign individual, a trust or partnership. So we still maintain the fact in year 1, W, which is a foreign corporation, forms and contributes asset to X. So let's see how the flow chart looks like. Year 1, as you can see the arrow going down. W, which is a foreign company, formed this U.S. domestic limited liability company, U.S. single member LLC, and it contributed this asset. So when we say asset could be a whole lot of things. You could have an intangible and tangible asset. For simplicity's sake, I provided examples of assets that could be contributed. It's not limited to this asset that I have provided, but to just make it so that you understand it, we're going to assume that W, which is a foreign corporation, in year one formed this domestic limited liability company or U.S. single member LLC and contributed a car, a house, and money in year one to this U.S. LLC. This is considered as contribution, which needs to be reported on the Form 5472. Now let's move on to what the other fact states. So it says in year two, W contribute funds to X. Let's see how it looks like on the flowchart. So once again, you have W, which is a foreign corporation who formed X, a domestic liability company, a U.S. single member LLC. We are also going to assume that this U.S. single member LLC has not elected to be treated as a corporation. That distinction is very important, because if it has elected to be treated as a corporation, our analysis here will be different. So throughout this presentation, our focus is going to be on a U.S. single member LLC that's seen as disregarded. We're only dealing with disregarded entity right here. So year two, W contribute funds to X. So as you can see, the funds flow from W to X, and this is also considered as contribution. And let's move on. Year three, X makes payment to W. So now it's rather the U.S. single member LLC or the disregarded entity making payment to its parent, which is the W, which is a foreign corporation. So let's look at how that diagram looks like. So here you have funds going out in year three all the way to the foreign corporation. So the foreign corporation in this case here is the parent of this disregarded entity. So funds are moving up. Now, instead of moving downward, in year three, it's moving up. This is what we will call as a draw or distribution. So it's very important that you know the distinction between contribution and then distribution here. When the single member LLC makes payment to its parent or to its owner, whether it's an individual or a foreign corporation, it's considered as a draw or distribution. Okay, as long as the single member LLC is disregarded, that's what it's going to be. So in year four, X in liquidation distributes its assets to W. So here it tells us that X, for whatever reason, maybe management decided not to continue the business for which the single member LLC was formed, and so it's liquidated. Or maybe X could not meet its business obligations, so it's liquidated. So companies can be liquidated for so many reasons. So let's just stick to that. So X in liquidation distribute its asset to W. So let's look at how it looks like. So we know in year four, X, this U.S. single member LLC closed business. As at the time it was closing its business, it has money, it has a house, it has a car, and it decided to distribute it back to its owner. Here you have assets going all the way up to the foreign corporation after the liquidation. Now, what's next? So this all makes sense. Now, when you go into the Treasury regulation that I provided the example, you would see the example in there, and I've tried to simplify it here so that it makes sense to you. So how would we categorize this? This is going to be both a liquidation and distribution. So in year four, there's going to be the reporting of distribution of assets to W. So as you can see from year one, everything that took place here was a contribution. Year two, we have contribution. Year three, it was moving upwards, so we have distribution. Year four, there was liquidation and distribution. So all of that will trigger reporting. Now let's move on. Now, what is the analysis going to be? So here, the IRS also provided an analysis, and it says that X is disregarded as an entity separate from W. So it's saying that this U.S. single member LLC is a disregarded entity. That we all know. It also states that X is treated as an entity separate from W and classified as a domestic corporation for the purpose of Section 6038A. What does this all mean? This means that for the limited purpose of filing Proforma 1120 and 5472, this X, a limited liability company, which is a U.S. single member LLC, will be treated as a domestic corporation only for the purpose of filing Proforma 1120 and 5472. I know a lot of you get confused thinking that when you file these forms, your company is going to be treated as a corporation. No, that is not the case. It is only being treated as a domestic corporation for just this purpose, for the purpose of filing the 1120 and the 5472 reporting. And that's it. This requirement does not transform your LLC into a domestic corporation for all purposes. No, just for this reporting and you're done. The IRS also goes forward to say that each of the transactions in year 1, year 2, year 3, year 4 is a reportable transaction with respect to X. When we say with respect to X, it means that it is X that makes the report, not the foreign corporation. So the X in year 1, X is going to report that in year 1, it receives all this asset from W, its parent or its owner, which is a foreign corporation. In year 2, X will report that it received funds from its parent, which is a foreign corporation, or its owner, or its member. In year 3, X is going to report that it made distribution to its member, its owner, or its parent, which is a foreign corporation here. Once again, this entity can be a foreign individual, it could be a foreign trust, it could be a foreign partnership. It does not have to necessarily be a foreign corporation. So that distinction is very important. In year 4, when the business closed, there's also a reportable transaction, and you can see that X, the U.S. single member LLC, distributed the remaining assets to its parent, its owner, its member. And so there's going to be a reporting transaction, as the IRS have stated here. And then the IRS concluded that therefore X has a Section 6038A. And that essentially means that X has to file the 1120 and the 5472 reporting. And then it also has the record maintenance requirement from year 1 through year 4. And the record maintenance requirement is what I stated earlier when I started in the beginning. Whatever you put on the 5472, you must have the records in place. You must have proper set of books. You must have proper bookkeeping or proper receipts to show that these transactions actually really took place. So the record maintenance requirement is there upon demand. IRS can demand that, you show them the proof of all these transactions and then you provide it. And so most of the time, I advise business owners to set up QuickBooks or any kind of an accounting software to record some of these transactions. I also advise them to have a record maintenance system where they put in their receipts and all of that stuff, like wire transfer, title documents to your assets and all of that, because those will be very important in case the IRS comes back asking questions about the information you put on the 5472. Now, let's move forward. Now that we've talked about all these years, what's going to be the due date? We know X is required to file all these activities that took place in all these years, okay? So we're going to take a look at year 1. When is X required to report this contribution in year 1? If X is filing its taxes on a calendar year, which means that from January to December 31st, then it has to wait till year 2 and file these forms, this Proforma 1120 and 5472 on or before April 15, year 2. With regard to year 2, X has to wait until year 3 and file this transaction here, which is a contribution, and report it on 5472 on or before April 15, year 3. Year 3, X is going to do the same thing. It's going to report this distribution on the Proforma 1120 and 5472, but it has to do it on or before April 15, year 4. Year 4, this transaction here, when X liquidated, let's just say that X liquidated on December 31, year 4. X has to file its final return on or before April 15, year 5. I get a lot of questions. People just form their LLC today and they ask me, when is this form due? When you form your LLC this year, it doesn't matter which year you're listening to me. When you form it this year, you don't file anything this year until next year. So you have to wait until next year on or before April 15. So when we say on or before April 15, means that you can start in January, you can start in February, March, but it has to be done on or before April 15. So you can even wait on the actual April 15 and file it. If you cannot file these forms on time by April 15, you can seek a 6-month extension, but the extension also has to be done on time. The extension can be filed on or before April 15. You cannot wait until after April 15 to file an extension. Otherwise, the extension will be invalid. So it's always important that the year the transaction occurred is not the same year you reported. You have to wait till the following year and then report it on or before April 15. So I hope this helps you out. And if you have any questions, feel free to use the link below and book an appointment with me. In the next video, we're going to deal with the example 2, which is I think the last example in this treasury regulation. Thank you and have a good day. Bye.